Hello everyone, welcome to this special episode on bond markets update. You have all been hearing about the stock markets for past 3-4 years. Now you know what's happening in the equity market. People are tired, markets are not going anywhere. Everybody is worried about what's happening in the equity market. Not much of an opportunity is visible. But when opportunity stops at one place, make no mistake, opportunity opens up elsewhere. Today, we are going to talk about an opportunity which gives you an equity kind of a return without the equity market risk itself. We are going to talk to a very eminent person today, CIO of Silverdale Fund, Mr. Sanjay Guglani. Very interesting episode. Please stay till the end of this video. We are going to give you something which you have never heard before. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to talk about how you can create equity kind of a return without passing through the risk of the equity market, we have today to talk to you and bring the one another opportunity, Mr. Sanjay Guglani. Mr. Sanjay Guglani is founder and chief investment officer at Silverdale Funds in Singapore. Sanjay has over 34 years of investment experience. He manages over $1 billion. His funds have received top performing funds globally awards, and it is used by a lot of institutions to park the customers' money to make most out of the bond market. Professionally, he is a chartered accountant by profession, a management accountant, a company secretary, and a Sloan Fellow of Management from London Business School. Welcome to this episode, Sanjay ji. And last time when you appeared on our channel, our audience was thrilled to hear your voice. Now it's over to you now. And what do you have to say for our audience?
Thank you, Dr. Bhatt. It's always a pleasure to be on your channel. Thank you very much for all the love and attention given by your audience. The timings are only becoming better. The higher the uncertainty, more people want certainty. And of course, fixed income is extremely doing very, very well. Several funds have delivered between 13 to 23% return last year. And year to date, we've delivered between 5 to 8% return. So touch wood, all things going well. And this is just the beginning. Just to remind the viewers, we only had one rate cut way back almost a year ago. So as the rate cuts happen, it becomes more and more attractive.
Sanjay, there are a lot of new viewers are there from the time you appeared on my channel last time. For the benefit of those people, could you please take me through what Silverdale Funds, what do you do, a bit of your background? Let's hear this from your own words.
Thank you, Dr. Bhatt. As Dr. Bhatt mentioned, I am the founder and CIO of Silverdale Funds. By profession, I'm a chartered accountant, cost accountant, company secretary, Sloan Fellow London Business School, and the only thing I've done is investments. So that's what I do. I'm the key founder of Silverdale Group. We started in early 2000 in Geneva and London, where we had joint ventures with Goldman Sachs, Morgan Stanley, and Lehman Brothers. In 2008, we moved to Singapore. In Singapore, we're regulated by Monetary Authority of Singapore. As people know, MAS is the gold standard in regulation. So one of the highly respected regulators, equivalent to SEC of US. And if you were to compare from the India, it's the SEBI and RBI roll into one. The beauty of being in Singapore is that both the fund and the fund manager are onshore in Singapore. There's no regulatory arbitrage of fund being in Cayman or Bermuda. Something goes wrong, you do not know where to go and how to enforce. Both the fund and the fund manager are under the same regulator, which is Monetary Authority of Singapore. We manage about $1 billion. We are a pure play fixed income fund house. The only thing we do is fixed income. Manage both open-ended funds like the Silverdale Bond Fund, which targets typically 8 to 10% return. Silverdale High Yield Credit Opportunity Funds targets typically 10 to 12% return. Silverdale India USD Bond Fund, which targets about 79% return. And of course, the most popular, which all of you love, are our target return funds, which typically gives 8 to 10% per annum. And the target return fund, for example, February 2029 is talking about 30% return in next 3.5 years. What is unique about our funds? I think is the fact that our track record, we have a track record of winning performance awards every single year of our existence, and that includes the COVID 2020. Our funds have typically delivered about 20 to 30% higher than the peers and the indices. And currently, the prevailing high yield, of course, gives further tailwinds. And I'm sure Dr. Bhatt will discuss this as we go further.
Sanjay, good to hear this, but people are tired right now with equity. Tantrums, tariff, Trump, every T word is bringing some kind of tantrum within for the investors. When the equity returns going nowhere from here onwards, I remember you speaking to me about one of the reports where you got when you see the P ratio touching 22, 23, it's a scary situation beyond that point where that index is likely to give sub 2% returns for the next 10 years. Scary, scary indeed. And people are still gung-ho about, US market being the ultimate equity market and it's going nowhere else. It's time the seasoned investors as well as the novice who are being catered by the advisors should look for opportunities beyond equity, which takes us to the bond universe. Before we get started, let's ask you, how does the bond market look like from the next 12, 18%? And what message you have for people who are looking for opportunities in the fixed income space?
Let me take a global view there. So if you were to go back in time and look at the big picture view, you realize that the period after the Second World War was the most peaceful the humanity has ever seen. And most importantly, what it led was the depoliticalization of trade. The trade was taken away from politics and trade was being handled through WTO channels. The countries opened up, the countries got into specialization, the global trade and commerce, flourished. And the humanity saw one of the best prosperity growth in terms of incomes, living standards, etc. And US, which led the wave, rode the wave, and became the even wealthier nation, the most wealthy nation in the world. Today, that global order is being threatened. This is seismic change. And let's not get carried away by the noise. Look at the big picture. The global world order is being changed. There was a reason why the US equities had to do well, because of the factor productivity for the innovations. But what has happened now is in terms of the aggressive policy which the current president is going in terms of immigration, in terms of tariff, in terms of trade, in terms of deregulations. To give a color to you, the tariff in US, what we call customs duty in India, was about 2.3%. That has been increased to close to about 14% today. This is the highest tariff since 1941. So we have gone to almost pre-WTO days. So this is, and the total impact of it is still unfolding because of the rapid shifts in the policies. It's very easy to talk about 50% tariff. 50% tariff is no tariff. It's called trade embargo. How many industries in the world would have 50% profit margin to absorb the custom duty and to be paid to maintain the prices? So let's understand what it basically means. So what you're mentioning in terms of equity, the exceptional quality of the US equity is something we need to be careful about. Coming to the other aspect of the whole thing, these developments have muddled the economic indicators. We have not yet seen the full impact of tariff, for example, or immigration, for example. This all uncertainty has actually made fixed income shine brighter, because fixed income, by definition, give you higher assurance of returns. And because of elevated yields, as we discussed last time, I'll take us 30 seconds there. As I mentioned last time, the 21-22 saw the fastest rate hike ever. As a result of which, we saw a M2M loss, which was the biggest loss in 236 years. As a result of which, the yields are far, far higher than they should be. On an average, the bond yields today are 2 to 3 times of the average bond yields. This is truly exceptional time. You're getting 2 to 3 times of what return you should get. So beauty is this. One side we are seeing huge amount of uncertainty. On the other side, where we get certainty, the high assured income is 2 to 3 times the normal return. So it's brilliant times for the investors to look into it. As per JP Morgan, the starting yield is the best indicator of potential return. Let's simplify. See, if you invest into a bond which is giving you 6%, your income will be 6%, right? So 88% of the bond fund return is determined by the starting yield. And the starting yield are at the multi-decade high. So it makes tremendous sense for the investors to lock in these returns. You asked what do we foresee? We're going to see interest rate cut. When the interest rate cut, they would have a fantastic impact on the bonds. As we all know, when the interest rate are cut, the bond prices go up. Let me simplify. If for a 1 year bond, if the interest rate cut by 1%, the bond price will appreciate by 1%. So in case of Silverdale funds, for example, a 1% cut in the interest rate would increase the NAV of Silverdale funds between 2 to 5% over and above the high yield you are getting. So the takeaway to you is that, yes, from where we stand, we see a very, very bright future for fixed income, and the show has just begun.
When it comes to question of bond market, many people think it's risk free. I beg to disagree. You also know this, and bond markets are also can drop down because of a rise in interest rate or may move up because of the fall in interest rate. But investors are also looking for something called predictable kind of a return from the bond market. Is there a way where you can design or have you designed a bond fund which gives a predictability of return when somebody invests? What have you done as a fund house there?
Very, very good question. So let me reiterate what Dr. Bhatt has mentioned. So when people invest into fixed income, they think the return will be fixed, which is nothing wrong in expecting, because we all know the bond price can come down, but on maturity, you get par value back. I repeat the sentence again, the same sentence. The bond prices can come down. On maturity, you get par value back. What did I tell you? The bond prices can come down. So what happens is, in the interim period, when the bond prices come down, you feel jittery about it. So was I investing into bond fund? How can bond fund NAV come down? Simply because the bond price is also linked to market price. Therefore, that's the most important thing. Therefore, what we have been focusing on is the target return funds. Target return funds, just to highlight to you, has been the most popular product in the world in the Q4 of 2024, attracting more than $1.3 trillion. And by whom? By the largest pension funds, insurance companies of the world. Because like any layman investor, they also want high assurance of return. So the target return funds have a fixed tenor and a target return. So the way to understand a FMP or target return fund is this. The way a bond, no, take a step back. What is a bond? Bond is like a fixed deposit, which can be traded in the market. Oversimplify, you got the gist of it. So in case of bond, you know the maturity of the bond. It's a 5-year bond means you get money after 5 years. You know how much return you'll get. Coupon is 6% means you get 6% per annum. So in case of a bond, you have a predetermined income called interest coupons, predetermined maturity when the bond will be paid back. What we have done is we take the same principle to create a target return fund which has a predetermined income called dividends, predetermined maturity or tenor of the fund. Now, the moment we do that, you have a certainty in terms of returns. As per the Bloomberg report of August 2023, the chances of a 5-year fixed maturity portfolio achieving its target is 91.5%. For Silverdale, it has been 100%. So, for example, the Silverdale FMPs, which mature in 2023-2024, just after the COVID, still gave 24-25% return when the market was down by 17-18%. So let me take an example, which is the worst example, right? In that worst example also, they gave whatever was the target return. And beauty is this, the reason why we are market leaders in terms of the fixed maturity funds is because our funds have an enhanced return because of prudential leverage. So not only getting higher assurance of return, you're getting even a return itself is enhanced. So surety plus higher return.
But Sanjay, one of the intriguing aspects of this strategy is that you use leverage, right? Leverage most of the time is a bad word in the investing universe. How do you use this leverage and create that return without compromising the safety aspect of it? Assume our viewers and investors are somebody who are novice, who are exposed to this for the first time today, and get to their level and explain this whole concept.
Okay, so let me take a first step back. What is leverage? So very simple. So if you have $100 with you and you're earning 7%, you make $7 as income. Simple. But if you can leverage it 1:1, what's called loan against securities, and borrow $100 against it, for on $200 at the rate of 7%, you make $14 as your income. The $100 which you borrowed at the rate of 5%, you will lose $5 as your interest cost. So how much is your income? $14 income, $5 expenditure paid, $9 take home. So when the world is earning 7, you're earning 9. That's the beauty of leverage. Now, just to clarify this, the leverage results in superior risk-adjusted returns. For those who want to understand more theoretically, technically, they can look in terms of CAPM, the capital asset pricing model. The risk parity moves up on the efficient frontier. That's the mathematical reason why it happens. So rule of thumb is this. The rule of thumb, be careful. Rule of thumb is this: a prudential amount of moderate leverage should increase your return by 20 to 30% without increasing your risk. Now comes the important portion. Just to remind you, most funds in the world use leverage. In equities, we call FNO. What is FNO? Future and options is nothing but a leverage. When you do option trade, you use leverage. What is a commodity fund? We call it margin. What's margin? Leverage. In case of bond fund, they call it long short. What is short? Is leverage. But instead of doing long short, we prefer to take explicit leverage. By taking explicit leverage, we are able to control the risk better. Just because I've gone short on certain bonds, there's no law which says that the bond price can't go up. So I can even lose on the short book, which we saw the largest fund managers in the world, they lost money in terms of going short in LATAMs and in Russia and sector out there, right? When they do everything the other way around. So in our case, my short book can never go against me. If I bought $100, it can never be $200. $100 always been 100. And that is what I was mentioning to you. On a risk-adjusted basis, it's give you high return. I tell you now, same thing in a very simple language. Sir, you have $100 with you, you invest into 10 bonds. If you have $200 with you, you invest into 20 bonds. So you are diversified over larger number of corporations, larger number of sectors, and more importantly, if you require money, you can take leverage rather than doing a fire sale. So this leverage helps you to get diversification, and diversification is the only free lunch in the world, as we call it. Remember, when you're investing into fixed income, the key risk you're running is a default risk. That's the truth of life. The fact that Silverdale fund didn't have a default doesn't mean it cannot have a default. Just because you didn't get default doesn't mean you cannot get a default. And therefore, diversification is the only peer protection, and leverage helps you to increase the diversification. Now comes to your point. Look, it's a knife. You can use for surgery, you can use for killing somebody. So people should be commonsensical. Sir, please take leverage when your return is certain. Don't take a leverage and put it on uncertain things. Fixed income is naturally been created to have leverage. So almost 4 out of 5 investors in the world in fixed income use leverage. Be commonsensical about that. The cost of borrowing should be lower than the return you get. The asset, there should be no asset liability mismatch. If you are investing into 3-year bond, you borrow for 3 years, lock in the returns. So when we talk target return funds, a lot of people have this question: how is it possible to be such a good return? Because remember, our cost of borrowing, we're borrowing for 3 years. Today, the way the interest rate curve is standing, the cost of borrowing for 3 years is lower than cost of borrowing for 3 months. So I think there's a golden period of fixed income, and of course, leverage can give you even better return as long as you have to be prudential about the whole thing.
Sanjay, very interesting. But one problem remains. The fixed maturity plans or the target return fund, what you call, is a short-term phenomenon. So I think it's from 2 to 4 years kind of a period that you float this. But what about somebody who has a long-term investor? See, I'll give you the practical cases. There are people who come back from US. They hold dollars. They come back to India. They move to some other geographies. They have to hold this money for a longer period of time. These are identified for certain life goals, like, for retirement, for purchase of a house outside of India, for educating the children. So they have a need to hold it for a longer period of time. So how do you solve this particular problem without compromising too much on the return side?
Very, very important question. And it's very important to understand this. So when you are investing for long term, longer the duration, more the risk. You, for example, you are giving a loan to me for 1 year, it's okay. If you want to give loan to me for 100 years, I may not even exist. So longer the duration, more the risk. That is where the target return funds, the FMPs, have a very interesting role to play. So it's a long-term play with pauses in between. So now to put the practical angle to the whole thing. So the 3 to 5 year is called the belly of the curve, which has the maximum juice. We know interest rate will come down. If I put it into 1 month bond, they'll also appreciate. But return is only for 1 month. If I invest into longer period, 7 years, the volatility is too high for me to bear. So 3 to 5 year is the belly of the curve where maximum juice lies. Don't compromise on that. I'll also make one very important caveat. Remember, the central bank, whether it is a Federal Reserve of US or Reserve Bank of India, the central bank determines monetary policy, which impacts only short-term interest rate. Fed Reserve determines only overnight rates. All other rates are determined by the market. So the influence of the monetary policy is the short end of the interest rate. The long end of the interest rate is determined by the fiscal policy. That is the reason why in the US you are seeing the long-term interest not coming down because fiscal deficit in the US is high. Let's not confuse it. We want a definitiveness of income in our future. 20-25 years is fine. So what happens is this. When a fixed maturity fund matures, you can roll it over for next 10 years. Right? So if you roll it over, you make higher return with the same certainty of return which target return fund gives. Right? To give an example to you, if you're looking into Civil FMP 2023, it delivered about 24% return in 3.2 years. Now people could roll it over for another 4.2 years and earn 43% return. What does it mean? It means people earn 77% return in 7.4 years. Had you invested into the index, you would have earned about 11%, right? Now, one more nuance on top of it. Because you are rolling over your investment, legally speaking, the ISIN of your fund doesn't change, which means there's no tax incidence. So if you're rolling, there's no tax to be paid also. So the beauty is that you get a high return, you get compounding of return, and you don't pay tax. And you will pay tax only to the extent of the money you take it out when you take it out. And in this period, you have certainty of your returns. So this is much easier way when you know exactly what you're getting bit by bit rather than saying, okay, I'll one fine day open the black box, find something interesting.
I personally feel every returning NRI should look at this opportunity. You have worked outside of India for long. You have that love for those dollars. You don't know where to keep it. You are perturbed by that low FCNR and RFC rates of return, and you're unnecessarily blocking them within India. When there is an opportunity like this comes in via an excellent regulator like Monetary Authority of Singapore, you should keep the mind open and try to use this best opportunity. By the way, for those of you who are our clients, who are using our services, who are intending to use our services, for last 1 year or so, we have been working on this and we have provided in our list of services the availability of target return fund for you. If any of you are interested to make best use of it, you can reach out to us. Our numbers are given in the description box below. We have also provided a WhatsApp link there. Click on the WhatsApp, just type TRF, target return fund, and send it, and one of our experts will help you to zero in on how you can lock into this target return fund. Sanjay, just to summarize what you said, so if somebody is a long-term investor, so don't at the entry lock in for a long period of time. Rather, take the journey in stages. So you go for that whatever is that a max which is available, which you think is the bottom of the that curve where the maximum juices are possible. Take a breather there. Just roll over to the next available rate. Thereby, you don't have a tax incidence. You don't need to pay out the taxes. Just keep rolling out. And this helps you to manage the risk as well as compound. So you earn certain $100 became 130, assuming that it made 30%. When you roll over, it is 130 which gets rolled over, not the 100 rolled over. And since the instrument has the same ISIN number, it does not create a tax incidence on rollover. Fantastic opportunity. Somebody comes back to India at 50 years of age, takes up an employment here in India, you are liable to pay taxes here. Look, you have got 2 years of RNOR phase, you don't pay the taxes. What will you do after that? So it will be treated as overseas income of a resident Indian. Instead, use this rollover option. Go as much as possible or till the day you need this money. Let's say that you hold it for 60 years, by which time you retire and you don't have an active income. Probably you can structure your withdrawal in such a way that even post that date, it's possible for you to withdraw within a tolerance band of tax limits. So you need to work with the advisor. See, it's not something it's can be discussed just on a screen here, or we can advise you on this. Make best use of advisors, take their assistance, go through the fact find session, let the advisor understand what exactly is happening in your life. Then they'll be able to suggest you the right thing. Make best use of it. Sanjay, I will ask you an unpleasant question. I know you don't like this, but I need to ask this. People are worried about dollars. Gold is rising. US, the balance sheet is bloated. No one knows will what happens to the US, what happens to the dollars. That's like a pain point or a nagging worry which is there for the investors. You are in the center of this dollar trade and everything. How do you see this picture? Is there a real concern for worry? Or if such an incident were to happen, when it will happen? Are there previous examples of, let's say, UK or some other country passing through similar phase? And please enlighten my audience about their worries on existence of US dollars.
It's a very big question. Okay. So let's understand what's happening in US dollar from a big point of view and from historic point of view, and then we see interaction points. So the key reason why people are uncomfortable with US dollar is the fact that we're seeing US dollar depreciating recently. I want to highlight to people remember that since COVID, US dollar had appreciated by almost 15%. And even after current depreciation, it is close to long-term average. I repeat again, it has appreciated after the COVID time. It has come down to the long-term average. So in pure mathematical term point of view, there is no sharp depreciation in US dollar. Having said that, I fully acknowledge people begin concerned of US dollar principally because the US fiscal deficit is at 6.4% approximately, which is not sustainable. What's fiscal deficit? Is very simple. Expenditure 7 trillion, income 5 trillion, therefore fiscal deficit 2 trillion. That's the basic problem in US. What does it mean? Theoretically, please don't panic, listen carefully. Theoretically, it means certain point in time, they will run out the money to pay. Does it actually happen? Answer is not really. I tell you why. First, what is sustainable level of fiscal deficit in US? Approximately 4%, being 2% growth rate, 2% inflation. Now, if you're going to have a fiscal deficit, it means that debt to GDP of the country will increase. When debt to GDP of the country increases and reaches a point of 2 times debt to GDP, after that point, it's very difficult for the economy to grow. That is, for example, what happened in Japan in 1980s, 90s. And that's what Japan is struggling in terms of growth. When would the US hit that 2 times debt to GDP ratio? Around 2045 to 2050. So we still have time to go. Do not panic. Then look at where we stand today. If you look into the global debt, the global debt is about $315 odd trillion, almost 100 times India's GDP, right? Out of which 60% is in US dollar. If you talk about corporate bonds, almost 70% of corporate bonds in the world are denominated in US dollars. Almost 90% of all foreign exchange trades in the world have one leg in US dollar. Almost 60% of global reserves are in US dollars. More than 50% of all remittances which happen across the border, whether it's in terms of loans or whether it's in terms of SWIFT transaction, is in US dollar. So the key point is no substitute to US dollar as on play. And importantly, and this is important for the investor point of view, because of such a dominance in terms of the global financial system, it has an unparalleled amount of liquidity and depth. No other currency or a country can come closer to it. This results in lower transaction cost and gives the investor ability to move in and move out. The so-called bid-ask spread, the operational cost is sit out there. So even if you want to invest into local currency, it makes sense for you in current circumstances to invest into US dollar and hedge the currency back in local currencies. You'll make more return. I'll give an example to you. If you look in terms of Silverdale target return fund for February 2029, you make 8.5% return in US dollar terms. If you hedge it back into Singapore dollars, you make 6% return against the Singapore risk-free rate, the government security rate of 1.7%. So you're getting almost 3 times the return by putting into US dollar and hedging back into Singapore dollar. Likewise, if you look in terms of INR, if you're okay with the INR holdings, if you convert that 8.5% into INR terms, it will be between 11 to 12%. Where do you get 11, 12% quality return? And as we discussed earlier, you can even be happy to even manage in terms of taxation. So the key takeaway is that please don't panic. Yes, we have seen the dollar retracing its appreciation. We also understand the dollar could be under pressure given a fiscal deficit. But if you want to take up exposure against local currencies, still it makes sense for you to invest into US dollar and hedge it back into local currencies.
They're really interesting, really interesting. One point audience always has in mind or always try to figure out is I want to find the right time to invest because that has been ingrained in their minds from continuous investments into the equity market. Is there something called a point of entry, opportune point of entry when it comes to question of investing in a bond fund or in a target return fund?
Okay, so the beauty of target return fund is very simple. You know the return on day one. You like it, you invest it, full stop. The return would not change subsequently, irrespective of the interest rate going up or coming down. So that's so target return funds are absolutely clean out, no problem whatsoever. But even if we are looking at open-ended funds, remember more money is lost waiting to entry than in the market. To give an example to you, over last decade and a half, 2 decades, if you had missed only one best month of the year in terms of investment, your returns would have been half. So against 8.2% return, for example, in case of high yield, your return will be about 4.1% return. If you miss just 2 months in a year, you are investing for 10 months, your return will be 83% lower. Instead of making 8.2%, you will have made about 1.4% return. So the key point to you is that time in the market is much more valuable than timing the market. And more so, remember, in fixed income, you are paid to hold. Longer you hold, more money you make. So it makes tremendous sense for you to look into it. I want to add one important thing here. When you are talking about equity return specifically, you begin with that same sentence in the beginning of conversation today. Just a color to you. Over last 30 years, 50 years, 70 years, if you look at it, the return between equity return and the bond return, the difference between equity return and the bond return is about 3%. People find difficult to believe. But yes, because of the recency bias, as we call it, look at the period of 30, 50, 70, 100 years. The difference between equity return and the bond return is approximately 3% per annum, with the bond funds giving you almost half the risk as compared to equities. So the key takeaway to you is that for a person who has medium to long-term horizon, bond fund makes still more sense and makes basically futile for you to try to time the market. It's like FD. You put FD for 3 years, you get 3 return. You FD for 10 years, you get 10 return.
Sanjay, one thought which comes to my mind is when we talk about the high yielding bonds, per se, it's like a small cap in a equity investing. Is it not risky? How do you manage risk around the high yield bonds?
So let me clarify this to you for the benefit of investors large. So bonds are rated by credit rating agencies. Anything which is triple B and above is considered to be investment grade. Anything below triple B is considered to be non-investment grade. Caveat, when we talk about credit rating, we talk about global credit rating. For an Indian, Government of India is AAA. For a Pakistani, Government of Pakistan is AAA. But we know from global point of view, the United States of America is not AAA, it's AA. Government of India is not AAA, it's triple B, but still investment grade, right? This is good. So first, let's get into quality wise what we're talking about. Now, when you talk about high yield, we're talking about the double B sort of bonds. For the first time in the history of humanity, since S&P has started rating bond sector out there, whatever you call it, the quality of high yield universe has been the best. To give color to you, typically double B used to be 30-35% of the universe. Today they are 50-55% of the universe. The quality of high yield has improved very sharply. And to give a put it the way around, the amount of defaults in IG is anyway zero, but even double B in last 25 years has been close to zero, 0.06. Now, on the top of it, remember, roughly about 36% of the high yield bonds are secure. Look, we all love to talk about credit rating, but I'm bothered about my bond. If my bond is secured, I'm happy. So from the high point of view, it makes tremendous sense to look into it. Two small caveats. Number one, hold on, Sanjay. If the quality of high yield becomes so fantastic, what about the triple C companies? Well, the companies which couldn't raise money publicly, they went and raised money privately. It's called private credit. Be careful. Number two is that in terms of the high yield universe itself, the duration of universe has also come down. Previously, the high yield universe should be 8 to 9 years. Today, talking about 4-5 years universe. To give a color to you, the amounts of bond which are due to be paid, high yield bond which are due to be paid this year is about $3 billion. And 80% of them are double B. We know double B, there's no default. So we're talking about the maximum possible default, or 100% of the bonds get defaulted is $1 billion. And that is the beauty of it. Of course, they never come back, not the 100% bond ever default. But to give color to you, so high yield is very interesting universe today, specifically in terms of publicly listed high yield universe, because it gives you incredible amount of return. To give color to you, Silverdale Credit Opportunities Fund, which is a high yield fund, last year delivered 23% return, which was higher than most equity funds in the world. Year to date, they delivered almost 8% return, which is one of the fantastic returns. And the YTM, the yield to maturity of the fund is about 10%. Since the S&P was born, it has given, return less than to double digit. And we're talking about bond fund, which gives double digit. So you got the face like this. So key takeaway is that high yield makes a tremendous sense for investors to look into it.
Dear viewers, we have given you one another extraordinary opportunity to make best use of at this sweet spot by using the bond funds. If it helped you to understand how to go around the bond fund investment, please do like this video. By the way, if you found this episode very useful, kindly share this with your friends and relatives, near and dear ones, and on all the social media on which you are connected with. Many of you watch my videos, forget to subscribe. Please do hit the subscribe button and press the bell icon. Do not forget to share these videos with near and dear ones, friends and relatives, and on all the WhatsApp groups on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another expert, with yet another thought next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.